Hi, Ben. How are you? So nice to see you.
So nice to see you. Thanks for having me on, really, we're recording in a great week because we just released the episode that you and I did for Compounders. So this is a this is a great week for the Ben Bougainville partnership.
Well, I'm very grateful for the conversation we had, and I told you that you have a very thoughtful way of asking questions, and you give the guest a chance to showcase what they're passionate about, what they do, and how they think about the world, how they think about investing. And you've done it so many times with so many fascinating guests that you developed a certain style that allows the guest to really shine for that hour or so. And I appreciated that little bit of, attention and spotlight because usually I'm the one asking questions. So it's fun to
Yep.
be on the other side now and then.
Yeah, and thank you. The funny thing about what you're saying is I have to I have to hold back my desire to speak and and be intentional about letting other people speak because I tend to I guess I'm kind of passionate about the specific subjects, and I will keep going. And so the podcast is a great way for me to just ask a question and let the guest speak and not have to editorialize everything.
It's fascinating, and I'll ask you about podcasting later on in this conversation. But I think, well, somebody pointed it out that I can listen, and I think it's very important in the work that we do that we can actually listen. And it's both in situations where we sit down with clients or prospects, and when we sit down with businesses or managements that we invest in, that you actually listen. Because if you listen, you can walk away with so much more. But I think it's so hard because we're spending so much time thinking about what am I going to say? Am I going to come across smart? But if you actually sit down and listen, I think you can walk away with a lot from a lot of interactions out there that we have in our business.
Well, especially when you're talking to company management teams, right? The goal of those interactions is not for them to hear your opinions, I don't think, unless you're an activist or that's like you're trying to educate them about your own beliefs. Really, what you're trying to do is extract as much information from them in a very friendly way. And people love to talk about themselves, as I think, whatever. We're podcast hosts for a living, so we recognize how much people like to talk about themselves, and that's why we're here. But yeah, I mean, I think the art of interviewing management teams, which I think podcasting helps a lot with, the is that art is based on the desire to, in a very friendly manner that doesn't seem like you are judging or accusing or prying, get as
Mm-hmm.
much information out of them as possible in a very truncated time, because it's not like you have unlimited time with management, so that you can make an investment decision. And you may not have thought about this, but you probably have. But I mean, what we do in the podcast and interviewing people is not so different from what you're doing when you're meeting management team. You're
True.
kind of interviewing them and say, I have a portfolio, I have capital. I'm interviewing you to be, a candidate to participate in my portfolio.
Mm-hmm.
Now that most people don't frame the conversation that way, right? Like this is a business, you're learning about it, but that's really what you're doing. And so the better questions you ask, the more you listen, the way you follow up, I think is the way you distinguish yourself in those interactions.
I've been in meetings with managements where it was a bunch of analysts years ago, and I was always curious what other people are asking about. And I would say that 90% of the questions were about the next quarter. And I would sit there and I would ask about the big picture. And I was a kid, I'm 43 now. I still feel like a kid, but I was really a kid at some point sitting in those rooms. And because I asked questions beyond that quarter, I had CEOs ask me to wait after that. And do you mind asking, like, do you mind waiting because of the questions you asked? And nobody ever asked us about this or that, a longer term view. And I found it so refreshing because to me it was obvious that this is what I care about. Where are you going to be in 5 years, 10 years? But so much attention is on the short term that the managements would love to talk about the long term, but they never get to. They hardly ever do. And I think in the work that you do, and we'll talk about it in a second, I think you can ask about the long term in the segment of the market that you're curious about. But before I get there, I love asking my guests, as you know, about their childhood and upbringing, and I have to ask you too. I'm curious how you think that time shaped you, your curiosity, and also your relationship with money. We're going to be talking a lot about money in this conversation, so I'm curious about those early days, if you indulge me.
Sure, sure. It's a great question. And I think when other people answer it, it's easier to draw a straight line of some kind in some cases of like how your childhood shaped the who you are today. And of course it did, but I but I'll tell the story, and I'll give some anecdotes that I think have helped shape me. But I don't I've thought about this, and I don't. It's somehow sometimes it's hard for me to really pinpoint the like how those influence translated to where I sit today. But I'll tell you something that I don't really ever talk about. It's not because I'm avoiding it, but people don't know this about me. If you ask me where I grew up, I say I grew up in Tucson, Arizona.
Hmm.
That's true. I spent my middle school and high school years in Tucson, but I actually grew up about an hour south of Tucson on the Mexican border in a place called Nogales, Arizona, which is a tiny town with like 20,000 people. Spanish is the primary language. And so I grew up in a multicultural environment. And that was juxtaposed with the fact that my dad was from New York and we spent our summers in New York. So I was a, really small town kid from Southern Arizona, spending time in New York City, and in the suburbs of New York. And so that was an interesting cultural experience where it's just very, very different walking the streets of New York City and then like being in a small border town. So I think that's, I don't, getting to like, how does that shape you? I don't really know, right?
Hmm.
Hopefully that made me curious about the world, and hopefully, you know, um, maybe more empathetic in some ways to different people in different circumstances. So the tenor of that question that you're asking is typically a question about like how did some early experiences in your life get you to where you are now. So so this is, I think there is a little more of a direct line here.
Uh-huh.
So in during those summers in New York, I lived with my grandparents. My grandfather was an immigrant from Poland. He came here in the early 1920s, and his family got in the real estate business. They were first in the grocery business, and they said, wow, this is a really tough business. Why don't we just own these buildings? And so he and his family built a nice real estate business. So from the age of basically 14 until I left the business, and what was I was probably 27. Every summer, and then full time after college, but every summer I worked in the business. And so my grandfather was a huge influence on me because he was someone who lived through the Depression,
Hmm.
um, someone who had come here with not a whole lot, someone who had built up a very nice, a nice lifestyle through that period. And he was, there was a big generational gap. I mean, he was in his late 70s and early 80s, and I was, a teenager. And so, of course, there was always that tension. But he was a value investor in his own way. I didn't know what a value investor was. When other people were reading Berkshire letters, I was walking the streets of the Bronx with an
Uh-huh.
80-year-old guy trying to find a tenant for one of our buildings, right?
Uh-huh.
And talk about, different culture shock, right? Like the Bronx is very different from Westchester, where my grandfather lived, which is very different from Nogales, where I lived. So really just like very different circumstances. But the things that I think I learned from him is like it was about business analysis, right? So this may not be intuitive to people, but when you're a commercial landlord, which is what we weren't in the residential game. We're in commercial landlords. If you own commercial properties, you're looking for the best tenant for that space. And this is the Bronx, and so of course there's CVS and banks and stuff like that who are big companies that are operating in the Bronx, but most of the businesses are mom and pops.
Right.
And so we would spend an enormous amount of time trying to figure out who the right tenant is for a location. And so we would go to, if someone had another store, we'd go visit their store and we would sit there. And my grandfather was like the most patient man. He would sit there for hours watching people come in and out. And he had all these rules about like if you went into a deli, the way you know if it's a good deli, a busy deli, and a successful deli is how many people you have behind the counter. So he would go
Uh-huh.
and count the people behind the counter, right? So that nuanced understanding of how small businesses work, I
Hmm.
think what that really inoculated in me is this like idea of the importance of business analysis and understanding the businesses you're partnering with. And I think hopefully it instilled in me a curiosity about business. And so, in a lot of ways, it was an interesting training ground to be a public company investor and now a private company investor. I think I'm coming full circle a little bit because we're going to be focused mainly on small businesses. And so we're going back to, my days of walking the Bronx trying to find, the best deli to put in one of our buildings. So, So I think like if I think about mentors and influences that probably got me on the path I am today. I think about those times with my grandfather, who was a very conservative man, never used any leverage, right? Just was afraid of debt. Just he just grew up in a different world, and I think that conservatism was through osmosis. I absorbed that, and so I think value investing specifically spoke to me as a result of that.
Well, I love it on so many levels because I think there are at least two, three stories in what you just shared. One is the dual upbringing, right, in two different environments. I think it introduced you to the world that's much more nuanced than you would have thought had you grown up in just one of those places. And I think
Sure.
it's very, very helpful in life and in investing. And I've been a part of conversations where people are so biased, but just one place where they grew up and they don't realize that people don't have doormen living in the middle of the country, for example. I've been I mean, I laugh about it now, but I was in New York in an investment meeting when somebody would say, why wouldn't they wait for the doorman to do it for them? And I would say, you must be kidding, right? Like, not everybody has a doorman. But we are so siloed in a way by the upbringing that we have. There's a beautiful book that you might be familiar with. It's called The Inheritance Experience, written by Johnny Bronfman. It's an older dissertation. I work with families with wealth, and we quite often talk about inherited wealth. But anyways, there's a certain human experience where the environment that you grew up with, you think that everybody lives that way. I think it's very helpful to see other environments to realize, oh, it's actually a range, it's a variety. So I think that's helpful. And I love the story of your grandpa. And it's so many guests on this show brought up a story of a grandpa. And most recently was Jeff Gilbert, who was telling me a story of his grandpa. And he talked about curiosity the way you are talking. And I remember my grandparents telling me stories in the Great Depression era and all the lessons of no leverage and so on. I think what I'm hearing is that your grandpa was a very patient person and was willing to wait and had a huge discipline when it came to picking really, investments here, right? You're investing in your tenant the way you're investing these days in equities.
I think that's accurate. I think that's spot on.
And it's interesting because we assume that we start learning the minute we show up at some official institution, school or then college and so on, and we get a degree. But I think we absorb a lot of lessons long before. I think somebody told me, and I don't know if it's scientifically proven, that some sort of habits and some sort of level of curiosity gets established by the age of 9 or 10. And even money habits that we live with get established very early on. So that's why I'm always curious about it, because I feel like you were exposed to some very, very helpful principles that led you throughout your life and continue to guide you today. And I think it's helpful to pause for a second and look back and realize, when did it start? Who told me that for the first time? So I want to ask you about investing, because at some point you discovered investing. Was there a moment? Was there a book? Was there a conversation? How did you find investing that we're going to talk about today? More of the public market stock investing.
Yeah. I think there's a lot of unique things about my journey. The least unique thing about my journey is how I discovered investing. I was living with a friend of mine right after college. I was working for my family business, and I think anyone who's worked for a family business understands that there are differences in opinion based on generations about how a business should be run, and there are potential negative things that occur with your personal relationships if the business, if you have differences of opinion on the business. And so I was feeling, I think, a little bit like the business stuff was influencing my personal relationships with my dad and my grandfather. So I think I was maybe mm, subtly, or even maybe even less subtly, looking for something else. And so a friend of mine was working for a hedge fund, and he handed me Ben Graham's book, The Intelligent Investor. And I read this, and like so many other people who tell this exact same story, there's something about it that struck me that said, this is what I want to do. This is like how I've been thinking about the whole world my whole life. I was a value investor before I knew what a value investor was. And so I said, this is something that I could be excited about, right?
Uh-huh.
This curiosity, business analysis, all that stuff that I had maybe developed at a young age and hadn't really thought about the practical applications of it. I said, I want to do this. And so I spent a bunch of time learning, just teaching myself, reading books, like anything, like everyone else, like who self-teaches themselves, starting to do my own research. And I tried to get a job on the buy side. And honestly, I didn't have a whole lot. I had a background in real estate. That's what I'd studied at school. So all I had was a Wharton degree and a passion. And I was really lucky to get my first job on the buy side in '07 with another Penn guy who was spinning off from Goldman Sachs to start his own hedge fund. Now the timing was not great. It was end of 2007. We were just past the glory days of being able to start a hedge fund when anyone could raise $100 million.
Right.
And so, I lived through the financial crisis, which was, a scary but wonderful experience. So I feel lucky to have been through that because I remember those times. It's like those formative moments. It's like, how you remember your teenage years so well because they were so formative. It's like I remember '09 and '08 really well because it was so formative and early in my career as an investor. But, getting that first buy side job is a hard one, especially if you don't have a background. Didn't go through investment banking, didn't go through any of the traditional routes, right? Like, didn't take a bunch of finance classes. I was focused on real estate, maybe myopically focused on real estate, I think in hindsight. And so just getting that first job on the buy side was huge for me. And, I kind of leveraged that and just whatever passion plus some experience plus going to business school, allowed me to get my first role at Cove Street where I was spent 12 years at, but that was like my first true institutional experience. So, I think there's nothing unique about the discovery, but I guess the path that was unique was that within that was that I always had this sense of how do I differentiate myself? Because there's so many people like us who are smart, educated, have all the credentials, worked, maybe have a better last name than I have, right? Like, and how do you compete with that? Right. And the only way I could thought about competing with that is like do something that other people aren't willing to do. Right.
Mhm.
And so a lot of people know this, that, and this is why like I have a brand, right? This is where Compounders comes from. Like, why do people listen to me? Because they remember a blog I used to have back in the 2011 and 2012 called The Inoculated Investor, where I used, my claim to fame is I was one of two people who sat through the Berkshire meeting taking notes. And that these were pre Cap IQ days where they transcribed it, pre Yahoo streaming or CNBC streaming of the meeting. The only way in kind of '09 and 10 and 11, the only way you knew what happened was to be there, is to read someone's notes. And so that was how I, kind of got my name out there and tried to distinguish myself and differentiate myself in a very crowded space. And so I think, coming full circle in a lot of ways, trying to do, as we'll talk about what I'm doing now, like trying to find different ways to be and think and act differently and do things that other people perceive are too hard, or just like, taking notes for 6 hours. First year was by hand, which was probably like, like a version of torture that they put you through in after they capture you, right? Like take notes for 6 hours. But yeah, I mean, like do things that other people perceive are too hard, as a way to differentiate and distinguish yourself.
Wow, you touched on so many things that I took quick notes. But first of all, I think starting at that time, '07, and then '08, '09, I remember vividly because I was junior analyst at the time, 3-4 years into my career. And I remember this day when Lehman was falling apart and everything was happening. And I left my office and New York was busy. And people were still running around, the stores were full. And I thought that what we're seeing up there from the higher floor of the ivory tower, people don't know that, but there will be consequences that will touch everybody on that street at some point.
Yeah.
And half a year later, all the stores were shutting down. Taxis were begging you to use them. And you would go to not a restaurant, like a lunch place to pick up a sandwich. They would give you extra salad or something and say, please come back because we're having a hard time. And it was just a massive, far-reaching, implosion of the system for a period of time. And I have memories of that time, and I think it shaped me in some way because I realized, what would I do again if things are not going as well as I hoped. And I think it shapes you. And I think you're more risk averse. I'm curious if that's how you think about it. But I think, talking about your grandpa and the Great Depression, I think for us that period, I think shaped us. Don't you think that it had an impact on you going forward?
Totally, totally. Living through that, living through like just the decline in the markets, the panic every day, stock, the entire market moving on like tiny headlines about Merrill Lynch or Wachovia. You know what I'm saying? Like
Mm-hmm.
it was a crazy volatile time. I think there's of course a benefit to going through a hard time in your career,
Mm-hmm.
early in your career as a formative moment. And on the flip side, it's probably not great to have started your career in a time when the market just goes up for 10 years because you don't know that anything else. But if I think about, because I'm, as anyone who knows me, I'm pretty self-critical and try to be, pretty realistic about strengths and weaknesses. Like in a lot of ways, I think, the negative from that experience was that you always were worried that there was another 2009 around the corner,
Mm-hmm.
right? And maybe is that 2011 when there was that little European debt crisis? Was that 2015, 16, when there was an energy crisis, when there was a mini recession in 2018, 19, and then COVID again? Like all of these little things, like you're always worried that there's another '09. And if there's anything that I've had to fight and try to counteract is like I've done the work. I have a lot of conviction in this idea, right? Um, Not like that worry about like, well, my in my start of my career, everything went wrong, and so like just focusing too much on things that can go wrong, almost like worrying about things but in an unproductive manner. And so, I've with maybe that foundation for my family, and then in addition to going through '09, maybe it makes you a little too conservative, right? And maybe it doesn't it makes you worry too much about external stuff as opposed to trusting your own work and conviction. So as I said, I'm just constantly battling that, like, maybe inclination to try to figure out all the things that could go wrong as opposed to thinking about what if something good happens.
I love it. I think it's a certain dance between both being aware of how bad it can get, but also having this almost innocent beginner's mind where you realize I could be surprised on the upside. This stock could go up 50 times, right? Or 100 times. And I think it's being aware of the damage that a particular investment can do while being aware of the upside that can come from it. I heard this story, and I hope maybe somebody confirms it for me one day, that Ben Graham in his later years was pretty much not invested in the sense that we talk here, not invested in stocks because he was looking over his shoulder and he was absolutely certain that the Great Depression is coming any minute. It's been too long. And Phil Fisher, in his book Common Stocks and Common Profits, in the foreword, and I don't know which edition, but if I would recommend looking back and reading it, he basically explains that ever since we disconnected from the gold standard, we won't have, well, that's the aspiration, such a deep depression as the Great Depression. There will be other issues and consequences. But reading that book, I was thinking that Phil Fisher brought us to closer to the idea of quality, what kind of quality you're investing in. I'm sure we'll talk more about it, but he also, in that book, he kind of hints that there is a different framework and structure we're operating in. And there will be crises, that's certain, and there will be sell-offs and recessions. But in their nature will be different than the Great Depression that shaped in such a big way Ben Graham and some of our grandparents and great-grandparents as well. But to me, the big point is that as an investor, you continue to collect experiences, and it's helpful not to allow the bad experiences to stop you from acknowledging opportunities that are in front of you. You and I had a conversation, well, a couple of them, and privately, I believe you shared with me how you sat down and you wrote down your foundational principles that guide you. And I really like that, and it stayed with me. Could you share what they are and what made you write them down?
Yeah, sure. Maybe let me answer this the second question first. Like, why did I do this?
Yeah.
I've been through the process of building an institutional investment firm. When I started at Cove Street in 2011, it was a startup in a lot of ways. We had 275 million in assets, which is a great start, but it was a startup in a lot of ways. And so I watched, the founder there create a research process, the pillars that we focus on for every company. And so I've thought deeply about how you build an institutional investment firm. As I was transitioning away from Cove Street and thinking about my next steps, and we'll talk about my new venture at Devonshire, but I wanted to sit down and think about all the lessons I had learned. And there whatever 10 principles. There probably could have been 15, or there could have been 7, I don't know, but just like come up with certain things that I think are just core and necessary to be successful when you're starting a new investment venture. And so culture is really important to me, and we don't have a huge team now. I'm attracting people who want to work with us, and are willing to put in sweat equity because they see the potential in what we're doing, but we still don't have a big team. And so I wanted to have a document, a living document that will evolve and change, and hopefully not be, totally, end up being totally wrong, but just, you want it to be malleable, because organizations change and times change and people change. But I wanted to have something that we could share if we started to build a team, especially younger analysts, people who don't have the experiences. Like, I think you can, culture more than anything else is not about what's on a placard. It's not about what's on a website. It's about the actual processes and the way you treat people, and especially younger people, how they see you operate, right? That's the kind of culture that, that's how people really learn culture, but it also helps to have some foundational elements. So in anticipation that we were going to be successful, right, act as if, I wrote these down, and maybe the best way to do it is to go through them, one by one, and then I'll just give the context for, like, what is this? What is the root here? What am I trying to get at? So I'll do that. And so the first one is, and it's first for a reason, is that we don't win unless our clients win. And we never forget that. So the context there is that I have this fundamental belief that the best businesses in the world focus on their customers. In this case, it would be clients, but customers and employees first. And we don't, as I said, we don't have a lot of employees first, and right now, and so what we're focused on is customers. And so I think the problem with the investment management business is that it's one of the best businesses in the world. It scales so nicely, right? You don't need that many more people to run $1 billion versus 100 million, right? And so all of that money just flows down to the partners. And so, at a certain point, it becomes a game of asset gathering and getting bigger, and you almost get, like, there's so much money involved. There's a risk that you lose sight of what, like, exactly you're trying to do. And what you're trying to do is help your clients with, whatever is it retirement, whether it's, funding an organization, some charitable organizations, whatever their goals are, that's got to be your North Star, and you can never forget that. So the other thing, and I think a lot of people look at finance very cynically, that so many people have, like, this very zero sum perspective, where for every winner there's a loser. And I fundamentally don't believe that's how things work, because so much of life is relationships. And so the second one is that every action we take starts with a win-win partnership first orientation. And as we started to focus on the microcap space, it was my observation that there are a lot of investment firms and service providers out there who are always trying to take advantage of small companies. And we want to be the antithesis of that. So we want to start with a partnership first orientation, try to find win-wins, whether that's with existing shareholders or other constituents in the company. And of course, obviously Devonshire has to have a role and a business associated with that. But I fundamentally believe that you can find win-wins even in, what is a very competitive industry. Um, getting back to my days of analyzing tenants and learning about businesses from an early age, like we want to be in this not simply for the financial reward, but also for the joy of learning about new businesses. And we'll stop if it ever ceases to be fun. So I know you a little bit, Bogomil, and my guess is you get that same feeling when you're looking at a new business that I do. You actually like start to tingle a little bit. You're like, this is interesting. And it's not just about, ooh, I can make money off of this. It's like, wow, I didn't know this existed. I now understand a small corner of how the world works that I didn't understand before. And so I love that. And it's fun for me. And, I think you can have fun and make money in this business. And so, but if it ever, and I will be frank that I think in my last few years at Cove Street, there were some external things happening. Like we were unfortunately not growing anymore. Right. And it wasn't as fun. And, and I think the most important thing for me right now is that I'm having fun again. And a lot of that is because I'm learning about new businesses and I'm, spending the time with people who are also excited about learning about new businesses. Um, Next one is that the capital in a transaction is a commodity. There's so much money out there, private equity, public equity, everyone has money, but relationships are not commodities.
Right.
And especially if you're working with small businesses, either on the private or the public side, our sense is that we're going to win and lose based on our relationships
Hmm.
and our ability to serve as a bridge between different players in the ecosystem. So whether we're looking at a public company that we're interested in funding, potentially taking private, we or a private business whose founders are selling, they're taking their first institutional capital, like we're going to win and lose based on the relationships because we have to be allowed into the boardroom. We have to be allowed into a process where we have a chance to put capital to work there. And I just think the way you treat people, whether it's the bankers or the outsourced IR person or the management teams that we speak with, like I think that's how you're going to distinguish yourself because all money is green and everyone's going to try to offer these people money. And so you have to have a reason for why you can win. Um, And so getting back to what, coming kind of a little bit to what we talked about before, the next one is that while not guaranteed, success can come from doing things other people deem too hard or not worth their time.
Right.
So, getting to taking notes at a Berkshire meeting, or in this case, trying to figure out how to, you know, build a premium brand, which we'll talk about in the microcap space, and be a big check writer in a space that other people have decided is not worth their time, or whether you're considering it take private, which everyone tells us is too hard. I've been attracted to those situations, and I wrote a piece on my Substack, which I'm happy to share with people. But the title is a fine line between being different and crazy, right?
Uh-huh.
Different can be good in the investing context. Crazy is never good. And so there's a like you don't want to do things that are so hard that you're just literally, the base rate of success is so low that it's crazy. And so we're balancing that all the time. And so, but on top of all that, like we have this idea that we're going to do hard things and we're going to make mistakes. But if we fail along the way, they never come from a lack of effort or focus, right? We're going to try hard, and if we fail, we fail. But like that's we understand that you generate potentially outsized returns by trying hard things that other people are afraid to do, or someone told them to, when they first start their career, you can't do that. And we're going to try hard, and we're going to try to learn on the way and make mistakes, but it's never going to be a failure because we weren't working hard. Getting back to the win-win side, the next one is we'll not hesitate to refuse to work with companies or other partners who do not share our visions and principles. This is just, I think, whatever you call it, the no asshole rule, whatever you want to call it. We're just not going to work with people who don't understand that we're in it for a win-win. People who are excessively transactional or trying to extract things from companies, that could, shareholders, LPs, whatever it is, we're not going to be involved there. And we're happy to, not take on, we're happy not to take on partners. We're happy to not to partner with management teams that we don't think see our principles. So getting to what I was talking about, we think there's a wide open and evergreen opportunity to build a premium brand in the microcap space. And that starts with the premise that there are real businesses in microcap that have been neglected by other market constituents. I will tell you that the people I talk to in the microcap space, the execs, have not had a particularly glamorous role over the last 5 or 10 years because microcap has been in a recession that no one knows about or cares about.
Hmm.
And so these companies and these management teams have been neglected. And the idea that we are coming to them offering solutions, capital solutions, is very refreshing. And I'm hoping that if we do that for the next 3 or 5 years, we can have a brand where we get inbound, like whenever someone wants to do something, we get a first look at it, we get a chance to participate. So I got a couple more, and then I'm happy to pause for questions. So the next one is that there's still room in the lawyer-dominated world that we live in for handshake deals between constituents and partners, right? Like getting into this world of private equity and signing NDAs with people before you even talk to them is just so weird to me. Because I have this view that you can trust people, and that if but maybe that's naive, and maybe we're going to get burned. But I just think that, just like Buffett did all those handshake deals back in the day because people trusted him and he trusted them. I would like to believe that there's still room for that, but we
Hmm.
have to, and we do reserve the right to act forcefully in order to protect our LPs and our companies. The next one is about size. We're focused on microcap companies on the public side. We're focused on lower middle market companies on the private side. And so we believe size is the enemy of success. And we aim to never get too big to be unable to fund a company in our original investment universe, which means that something that we're investing in today, as Devonshire's in its early stages, right? I want to be in 5 or 7 years able to invest in the same size company, and not let size not drift up market where it's much more competitive, whether that's in small cap or in middle market private equity. Just stay small, focus on small businesses where you can actually have an edge in terms of the relationships and in terms of, I think, the analytical capable, what you can do on the analytical and diligence side. And this is the hardest one for me, the last one, because I was in public equities for so long and it was very difficult to raise assets. But the last one is, no matter what people say about the availability of capital, good deals get funded. And we have that phrase tattooed on our foreheads. You can't do what we're doing, right? Like, then we'll talk a little bit about what exactly, like the actualization of all of this, but you can't do what we're doing, especially in the microcap space, without believing that there's going to be capital available for a good deal. Like if you wake up every morning worried that you're never going to be able to fund the deal, and you're going to stop doing this. And so we just, whether it's naive, whether it's I don't even know what fanciful, we're going to continue to believe that if we find good deals and we find good partnerships and we find win-win opportunities, that there's going to be capital behind it. So those are the 10. Happy to dig into any of those if it makes sense.
Well, I love the fact that you're so precise about who you are and who you're not. And I love the list that you proposed and that you live by. And the one big thing that I see that all of them have in common is the people, that you're actually dealing with people. And I think we can forget that easily in the investment profession because it's just numbers or accounts and LPs and even, tickers and so on and symbols. And you can forget that it's real people running real businesses. And on the other side, these are real people who entrusted their life savings or a family fortune to you. And you have a huge responsibility on both sides. And I think it's fascinating what you mentioned, especially in the space that you operate in. We'll talk more about the microcap space. But across the board, I think in the investment profession, to be reminded that we're doing it for the people, with the people, I think it's very helpful. And I definitely benefited from the fact that I left a good impression of somebody and somebody returned my call and I could have a follow-up conversation about something one way or the other. I think it helped me a lot in business within some, corporate structures, but also with the outside world. That the investor relations remembered me. I was the nice guy that they actually wanted to talk to again. And somebody else was calling and they wouldn't take their call, right? So I think you get the feedback very quickly, what works in life. And if you think you can get places by being unkind to people, I think there's a quick lesson there. And it's the same with, clients, that you build a certain trust with them, and they know who you are and what you're all about. I had a couple of conversations on this podcast, and the one that comes back to mind is with Christian Billinger, who manages his family money out of London. And we talked about doing the right thing even if nobody is watching. And I think it's such a powerful idea, right? Like, if I buy shares of a certain company, I can learn as much as I think I can learn, and on and on and on, and keep abreast of all the earnings. But the truth is, I'm not in the room when the final little capital allocation decision is made. I have to know that I can trust the people who are making those decisions. And it's the same with my clients. They can ask all the questions, see all the statements, but at the end of the day, there has to be this invisible, intangible understanding that they know I will do the right thing even if nobody's watching. And I think it's such a powerful revelation. It's so helpful. And if you can find the right people in your life that you can say that I know they will do the right thing even if I'm not watching, and the other way around, that's a very happy, good place to be in. And I think that's what you're trying to do, find the right partners on this journey on all fronts. And I think that's hugely beneficial.
And having a document like this that has those principles, people are going to self-select in or out, right? Like, if those don't resonate with you, that's totally fine, but you're probably not a good partner for us, and that's totally fine as well, right? Like, this is not what we're doing, is certainly not for everybody. I mean, the word microcap is a four-letter word for a lot of people, right?
True.
Lower middle market is, attracted a lot of capital, but still, these are small businesses. And I was listening to a podcast with Brent Beshore just on the Knowledge Project the other day, talking about these crazy things that happen with small businesses. And I hear my partner talking about it. And yeah, it's hard. It's hands-on and it's hard. But in a lot of ways, I think, with my last years at Cove Street, I was looking for more engagement with maybe less time in models and spreadsheets and, sitting at a computer, and more time like building relationships. So you talk about people, and it's like, it sounds so silly to say that businesses are all about people, because of course, what else, but they're not run by robots, but you forget it. And so how do you keep your pulse on all of the people, all of the stakeholders, in any investment or in an investment firm? You have to create alignment, right? And is that the fees? Is that, obviously that's part of it, but that's how you treat people. It's how you follow up with people. It's it's the culture you create. And so I think, you talked about on our podcast about when March of 2020 happened, people were calling you and they just wanted to hear your voice, but they knew what you were doing. They knew you were buying, right? Because they know you, right? I want people, through documents like this and this podcast we do, to know who we are. And if that works, that's great. If it doesn't work, that's also fine. But like, we're going to be really, I think, clear about what we're doing, why we're doing it, what we think the opportunity is, how we're going to comport ourselves within an ecosystem of, I think, that unfortunately attracts unscrupulous players, whether those are management teams or service providers or bankers or whatever, or investors who try to screw over small companies. I think the way we comport ourselves and being the antithesis of that is going to be a brand builder over time. And it's like, I'm very clear to everyone. It's like, we're going to be long-term greedy here instead of short-term greedy.
I like the sound of that. Ben, I have 3 big questions related to what you're doing these days. So first of all, tell me more about the new investment strategy. Second, why are you doing this? And you kind of hinted. Why it may not work, because you thought about it, I know. And the big one is, why is almost no one else doing this? Why nobody wants to do that?
So hopefully I'll answer all of those questions, or at least the why it won't work one I will cover, but maybe I'll just give the backdrop here, and then hopefully that'll answer those questions. So during my time at Cove Street, it became really clear to me that there was an emerging and structural lack of capital available to small public companies. So the investment universe has changed dramatically since maybe the 2000 timeframe. Brian Bears of Bears Capital Management talks about starting a microcap strategy in the late 90s and it being an institutional strategy, meaning that like pensions, endowments, foundations were investing in microcap. And that is just by and large no longer the case today. Now, of course, there are exceptions, and of course, there are people who invest in microcap. I'm not saying there aren't, but what's happened is that the institutional investor base that covers microcaps has just been decimated. And look, unfortunately, my old firm is a good example of this. Small and microcap strategies, especially value, have been out of favor, right? Like, at Cove Street, we were in all the wrong places. We were in small versus large. We were in active versus passive. And we were in value versus growth, right? We were in all the wrong places. And so those, having everything, the S&P being such a beautiful return vehicle, so much money moving to passive, a lot of money moving to private equity. And like, if you want to, maybe you think microcaps are four-letter word. It's a broken industry. There's a adverse selection there. There's no good businesses in there. Well, let's move the money to middle market or lower middle market private equity instead, where there's this this idea that there's this long runway of businesses that need to be sold to recapitalize and all that, and that there's excess returns available there. And so what that means is that there are just fewer and fewer people looking at this space, but just layering on top of that, there just are not a lot of people who write big checks into this space. And so, I saw a number of times at Cove Street where we were looking at small cap and micro cap companies where there were liquidity events for founders and stuff like that, like, if someone wants to sell 30% of the stock of a micro cap, you might as well own the whole thing, right? That you're not getting out, right? Who's going to absorb that? How does that get into the market? Who's in position to write a big check to buy all that at once? And there just are not that many players because the long only players in the space aren't structured to do that, right? That's more of an alt strategy where you're buying a big stake in a company and you're, in a negotiated transaction and you have to set up an SPV and all this stuff like that's not really the long only world. And the hedge fund world has not been, I've been treated particularly kindly by all of the same things that have been happening. So that's the backdrop of like, this space in the microcap, and I'll define microcap, and these are loose things, but 500 million and below, and then maybe nanocap, it's 100 million and below. And so all of this is exacerbated in the nanocap space where there's just like no liquidity. These companies are far too small for most investors to look at. So all of these things have been true for years. But I think as investment firms and their LPs and their, whether it's there weren't as many 30-40 billion dollar endowments, right, as there are now, right? $100 million allocation to microcap doesn't make any sense, right? Like, why? That's not going to move the needle. So the space has been just abandoned. And when you layer on that the fact that whatever long period of time you look at, the Russell Microcap Index is the worst performing U.S. equity index on a relative basis. Everything's, the S&P's been a juggernaut, but even go up market cap, right? Not even to the S&P, and the Russell Microcap's the worst performing index. And so you have an out of favor index with illiquid stocks that people with a taint on them where people think there's no real businesses in the space. It's too small for most endowments, pensions, and the managers. Like, if you're good at microcap, guess what happens? You graduate to small cap or SMID. And so you graduate out of microcap so it's like there's a dearth of players in the space who are focused on it, who have the contrarian perception that there are real businesses in here, and that want to build a firm that stays small, that focuses on providing capital solutions to microcap companies, and also define that so that you understand where we're coming from. We basically have three ways we can play with companies. One, in a situation which I described where, small microcap company, there's a founding shareholder, CEO, whatever, large shareholder who needs liquidity for some reason. Either they're in ill health, which we saw at Cove Street, situation where there's a sponsor who's trying to get out because they're in the year 11 of their 7-year fund and and they got to get out, right? You see that. We see divorce. I mean, crazy things happen at all companies, but in a microcap company, that can be much more meaningful. So that's one way we can provide, liquidity to a selling shareholder. We could provide growth capital in a way that is a much more friendly version. So right now, if mostly these nano caps and the ones we're focused on now, if they need growth capital, They pay 15% off the top for an investment bank to help them raise that capital. They probably take a 20 to 25% discount to the stock price. They might have to give some, warrants to the purchasing hedge funds. And the typical players who do this are looking to buy and flip the stock in 6 months. So you basically you increase the dilution massively. You sell to people who don't want to hold the stock for the long run, and so those are the terms by which most companies have to raise capital. And it gets to the point that there just aren't that many people, especially the private equity firms, spending time in this space. People who can write a big check in more of a partnership, win-win, not like, yes, I am going to rake you over the coals to let you have my capital, and then I'm going to sell as quickly as possible. And so we aim to provide very friendly growth capital to companies, right? This gets back to the win-win perception. We want to partner with someone. We are buying X% of the company in a single transaction to help you facilitate growth, whether that's M&A, whether it's some kind of other organic strategy. We want to be your partners. And what you don't do when you're entering a partnership is beat the other person up so badly that that yes, we will partner with you, but only if you let me beat you up and take your money, right? And we're just not going to do that, right? And so that's not how. If you owned one of these companies in private as a private equity firm, you wouldn't extract exorbitant terms from the company you already are invested in in order to help it grow. You would fund it, right? And you would obviously reap the benefits of the success, but you're not trying to beat them over the head in the meantime. So that's the second way. And then the third thing, which is I think is the biggest opportunity over time for Devonshire, is that at some market cap threshold, is it 150 million, 200 million at market cap? Is it 100 million? Excuse me. At some threshold, it just no longer makes sense to be public for these companies. It's expensive, and it's becoming increasingly more expensive with the listing fees are going up, D&O insurance continues to go up, and it's just expensive relative to the size of these companies in order to be public. The second thing is it takes a lot of time. And if you're a huge company like Honeywell, you have IR people, you have all kinds of accounting and auditing and all these people who are involved in the whole process of being public. But with a small company, CEO, CFO, VP of finance, they're involved in everything. So the amount of time it takes talking to investors, filing Ks and Qs, doing quarterly calls, speaking to the sell side if there is any sell side coverage, right? Like we have CEOs tell us it takes a third of their time. And so what is the opportunity cost of that time? What could you be doing to build your business, build your culture, invest in your employees, invest in your customers? Spent, running a treadmill basically in a lot of ways with the investment community. And so our contrarian thesis is that there are a lot of companies in this space, and probably 85 to 90% of them are uninvestable from our perspective, the way, our cash flow oriented, profitability oriented, high margin, high return on capital perspective. They're just, you're going to screen out 85 to 90% of the universe immediately, but that leaves hundreds and hundreds of companies that we could potentially invest in. And our idea is that the public markets are no longer serving these companies well, and that the private markets are actually better funding vehicles for whatever their growth ambitions are. And so we aim to be a partner of choice in a situation where a management team would consider a take private. And I want to be really clear here. This is all management-led buyouts. We're not doing hostels. We're not coming in doing turnarounds. We're not ripping and replacing. Very similar to what we do on the private side of Devonshire, which is that we are a good third option for any seller, right? We're not a strategic, right? So we're not going to come in and try to extract synergies, and that probably means a lot of people get fired. The CEO probably doesn't have his or her job, right? We're not a PE firm with a platform, right? That's probably going to do a lot of the same things. We are a partner who's looking to be a bridge to the private market with friendly capital that has a true long-term perspective. And we're going to give you the opportunity to run your business the way that you want, without having to worry about quarterly earnings, without having to worry about, well, I really have this high return on investment that I want to make, but it's going to hurt EBITDA this next quarter. And if the stock goes down, then I no longer have my currency to do deals, because my stock is down, right? I hear I hear this. People tell me these things. They won't make investments because they don't think the market will like it. And so to me, there's just, given the cost of being public, the time of being public, there's just a subset of companies that we're going to be digging through and establishing relationships with over the next 3 to 5 years, that just could be great candidates for a very friendly management-led buyout where, and I'll be getting back to the win-win, we pay a fair price for a great business that just, for whatever reason, has had a lid on it. And part of that lid is the lack of access to capital in the public markets and possibly the time and bandwidth required to navigate the public markets for a firm that by definition doesn't have the resources to do so. Okay, so why won't this work? And why is no one else doing it? The reason, so there are a lot of investing, there are a lot of silos in the investing world. And
Right.
so there's the public-private silo, right? This is both. So this is hybrid. So, that may mean it's hard to raise money for because it doesn't fit in a box, but I think there's opportunity in terms of excess returns in hybrid strategies that blend the public and the private. I speak to a lot of middle market and lower middle market private equity people, and they spend 0 to 10% of their time on public companies. The take private is notoriously perceived by the lower middle market and middle market private equity guys as hard, too hard, way harder than buying a private business. And I don't disagree with that. It is 100% true that like the process associated with the taking company private is harder. But that's where the returns are, right? Like doing something that other people aren't willing to do because it's too hard. Mandates, a lot of these, I've spoken to middle market private equity guys who just can't take privates. It's not in their mandate. Their job is to buy private businesses, right? And I think the nuances of navigating stock prices that can move up or down during a process, a board which has a fiduciary duty, all of the legal cases that Delaware companies and the legal cases that inform that process make it just much harder. Plus you have outside shareholders who can vote it down, right? And so all of those, relative to, I know this small business owner, we've been calling on his business or his or her business for 12 years, and we're going to be the first capital they take because whenever they're ready, right? That's an easy transaction, right? These take privates are not easy. So that's one reason. It's just it's harder, and it's true. But there's a lot of silos that also prevent people from looking at it, which I think is where the opportunity is. The other thing is I think people believe that microcap is just broken, right? Broken companies, broken management teams, frauds, hucksters, companies that are serial equity raisers that never actually have a business. I mean, so that's true. And there's a lot of that in there, and that's unfortunate, right? And that's why we want to be have a different brand in the space, is because I think, unfortunately, people, the microcap brand is actually pretty poor. So, but my point to people is that you screen out 90, 85, 90% immediately, right? Just based on profitability, margins, some level of, like size, right? Some level of size. So it's like you can get to the list of 200 to 300 investable companies pretty quickly, and then it's just about establishing relationships and doing the work. And so the other reason that people don't do this is because it's perceived to not scale. Right? If you want to raise billions of dollars, it's a little hard to do. And so this gets to us, our willingness and ability to stay small. Now, the public microcap investing is a very distinctly unscalable strategy. If you want to be able to buy nano caps, it's hard to be over 100 million in AUM. That's not a scalable strategy. It's hard to build a firm. It's also not big enough for most LPs. And so no endowments and pensions are putting money there. And so it's just a tough business being a smaller microcap investor. But this strategy has the ability to scale a little bit more, because if you're doing take privates, if you're doing 25, 50, $75 million equity checks, right? If you had a fund structure, you could put plenty of money to work here, right? And it can be meaningful enough. So I just think people think it's just too small. And sure, if you have $20 billion in a large cap buyout fund, $500 million in a microcap focus fund doesn't make any sense. So I think those are some of the main reasons we hear why people don't do this. Okay. Now, why won't it work? I spent a lot of my time thinking about this, and believe me, we are told every day from different ways, different people in the ecosystem why this doesn't work. And so the first reason it doesn't work is that we don't have a fund yet, right? And so we would be reliant in whatever we're doing, whether it's take private, whether it's buying out a selling shareholder, we'd be reliant on finding the capital. And so I think people worry that like it's very difficult to underwrite a deal and a manager at the same time, and having committed capital is really the right way to do it. And so I agree with that. What we're trying to do is challenging, right? But the opportunity set is so big, is that if we could get a couple transactions across the line, I think it becomes really clear that like a committed capital vehicle makes sense here. The other thing is that dealing with public companies, and this gets to why other people don't do it, is that dealing with public companies is just way more challenging than dealing with private ones in this process. So especially since, let's just take private, for example. We're going to be approaching companies that are not for sale, that, CEO may have may perceive some benefit to being a public company CEO. You have a board that you have to find, near unanimous support for if you're going to do something. You have outside shareholders who may go nuts if the company's bought for a premium that they don't think is legit justified. You're immediately going to get sued by some, ambulance chasing lawyers, right? And so the cost of doing all of this is substantial, right? And the time and the opportunity, and deals fall apart for all kinds of reasons, even private ones. But when a banker's bringing a deal to, like a private deal to us, and we see it 100%, right? Like that, not 100%. It's very likely that this thing is going to transact. With what we're doing, it's harder. We don't know. These companies aren't for sale. As I said, there's no banker involved. This is a big change, and you have a lot of constituents who might not love every aspect of it. And so this is why the relationship building part is really the most important thing. You need trust. They need to be able to trust that you can raise the money. They need to be able to trust that you do what you say you're going to do, that you're going to be a good partner, that you're going to be, involved but hands off, letting them run their business. And so that's just about time. And so the way I'd frame it, Bogomil, is like, I don't know where this is going to be in 5 years, but I know where. I don't know exactly how we're going to get there, but I kind of know what I need to have in 5 years. And what I need to have is a list of companies that I've been talking to for 5 years, checking in every quarter, supporting them in any way we can, saying, well, how can we be helpful? If it's not now, maybe it's 18 months from now. And if you have 40 or 50 companies that you're checking in with every 6 months, maybe one of those every year it has some actionable item that we're able to partner with them on. And that would be getting to staying small, like that would be a totally fine scenario for us. We don't have to have, a committed capital vehicle where we have to put do 7 to 12 deals in 2 years or 3 years or 4 years. Like, we don't have to go at that pace. I'm not trying to build the next KKR. What we're trying to do is stay small, focus on small businesses, focus on the people in these small businesses, develop relationships with them. And so that all of these things that we described, which are really hard, get easier because you have advocates on the inside. And so that's about incentives, aligning incentives. It's about the way you comport yourself, the way you treat people, the consistency that you follow up, and the way you treat, the way you ask questions, the depth of your diligence, right? As you said, right? Most people are asking about quarterly earnings, so we have a small bar to jump over, but we still need to be really good and make sure that we're asking the right questions that's based on the research. And so, I get there are a lot of reasons why this doesn't work. But the flip side of that is, if it does, we are tapping into one of the most, I think, attractive return ponds that you could find remaining in U.S. equities. And if you could establish a brand, which I think brands are incredibly important in investment management, right? If you have a brand, that means, you have a bad 18 months, you do a bad deal. If you have a good brand, that means you get another shot, right? If you don't have a good brand, you don't. And so if we have a brand that allows us to distinguish ourselves in the space among companies, other microcap investors, the lawyers who are active in this space, the bankers who are active in this space, and the people who could fund with these transactions. If we have that brand, then I think you create something that's repeatable and sustainable.
I think it's fascinating, and I've been in the business for 20 some years, and I continue to learn about the different pockets. And the pockets are not static, right? You revisit the same label, even microcap. It means different things at different times. I like what you said. It might be a big universe, but even in my universe, which tends to be larger, people could argue that maybe there are 500 or 1,000, maybe 2,000 stocks I could invest in. But honestly, between the two of us and the people listening, I probably have a list of 100 some companies that I would ever want to own, right? So our stories rhyme in that sense that if you actually look, what would you like to own? It's a shorter list than allegedly the entire addressable, investable market that you think of. It's much smaller if you pay attention and you have your filters in. I want to ask you if you and I could jump in a time machine of sorts and go back 40 years or 20 years. How different was the microcap world then than it is today? What's structurally different? Because I'm hearing the story that there's something different about this segment of the market for various reasons. Could you talk about that? It sounds like it's not the same than when Peter Lynch was writing his book One Up on Wall Street and looking at some smaller companies, not those maybe tiny ones, but it was a different world than it is today.
Yeah, I'm not going to pretend to be an expert in like the history of microcap, but I will say give you some common themes here that I hear pretty consistently. One is like most companies do not go public as microcaps anymore, right? Think
Mm-hmm.
about the big IPOs these days, right? They're massive companies. They're like VC led or growth equity companies that have stayed private for much longer, right? So the big difference, I think, is that the private markets are so well developed to fund small businesses, tiny businesses from the VC side, to growing but profitable businesses in private equity, to massive businesses like a SpaceX or something like that, which remains private and just whatever has a couple $100 billion valuation, right? Like or $100 billion valuation, whatever their last mark was. But you know what I'm saying? Like the private markets were not well enough structured, funded. There weren't enough people. There weren't enough. The ecosystem wasn't developed enough to be able to fund all those companies, and so companies stay private longer for a reason because there's capital available to them. Companies used to go public because that was the way to raise capital, right? You either sold yourself or you went public. That was the other thing. Like the growth equity that you see, the private equity transactions that exist now didn't exist like 30 years ago to this anywhere near the same degree. And so I think that's a big difference. Um, Another thing, I mean, we've just seen just a constant diminishing in the number of companies that are out there, public companies. And I think what that is a testament to the fact that whatever it is, and I wasn't investing in Peter Lynch's time, but it certainly feels like the world has become more and more short term. So the ability to run your business as a public company with the focus on the next 7 to 10 years, I think has become much more challenging. The private markets are just by definition better for that. I talked about the institutional nature of the microcap strategy. If it's no longer that, so you just have a different investor base, and you're just like there just aren't the big investors who used to be able to play in that space because it's now too perceived to be too small. And I also think that, and whether it's fair or not, there's a perception change, right? Small used to be kind of good and interesting, and this is how you find multi-baggers, and there's plenty of data that like Monster was a microcap at some point, and that
Mm-hmm.
Monster Beverage, and I mean that company's right. There's plenty of interesting stories about compounders that started at a very small market cap and now are massive. But I
Right.
think people think that if you're still public, you're still a microcap, that there's something wrong with it. Right. And I don't think that perception was always true, but these companies have like they're guilty until proven innocent. And I think some of that guilt, right, fair or not, has to do with the structure of the market and the capital available to these companies, right? Because a lot of companies need capital to grow, whether that's M&A, whether that's capex, whatever it is. And if the capital is not available to you at a price, at a good rate, at a price that makes sense, like you're either going to raise it and take massive dilution, which if things don't go well, then you've permanently impaired capital, or you're not going to take it at all, and you're just going to be in a stasis. And so I think there's there's the reality that some of these companies are small for a reason and they will forever be small. And then there are some of them that are just lacking maybe just what we can bring: capital, corporate governance, a little bit of operational expertise, a capital allocation North Star, right? Not transformational things, but just things on the margin that can unlock an opportunity set that's been there, but they've been unable to capture.
No, it's fascinating, and I think the fact that it's hard and people are not looking, it's interesting. And then uh, at the end of the day, you're looking at businesses, just as I'm looking at businesses, and these businesses need capital like any other business, and you might be in a position to bridge where they are or where they could be in terms of potential and size and so on. So it's fascinating to hear those stories, and it's also fascinating the history of the markets, how they evolve and change, right? Like the fact that we have such a big private market these days, that the IPOs we see, even the recent last few years, they go public when they're $50 billion or $100 billion companies. And I think in the past, if I remember right from some of the books, they would go public much earlier because nobody wanted to provide capital. So you could actually pick them up as much smaller companies. Ben, I want to ask you about two aspects of your life that kind of are related to investing and I think make you a better investor as well. I think that's my impression: podcasting and teaching. Can you talk about the two? You spend quite a bit of time doing both. And from my own experience, podcasting the last few years and writing, I think I'm becoming a better investor because I'm learning in public in a way. And every week I get to sit down and talk to people and get asked questions or get to ask questions like today. But tell me about your experience, both podcasting and teaching, what it's been like.
Yeah, that's a great question. The podcast has been an incredible experience. It's been a great way to build my network. It's a good way to connect with people who are doing all kinds of different things across the world, across different markets, that I would have never heard about otherwise. We started the podcast where I was interviewing public company CEOs only, and I learned so much from those interviews about how to manage people, about culture, about how to handle crises, how to go through turnarounds. So that was like the first incarnation, and we still do interview public company CEOs, but we've expanded that to private company CEOs and investment people like yourself. And so from the investment people, I'm fascinated by differences in approach, philosophy, market, size, just anything. And so I think that the tangible skills you develop from this it's really about, as we talked about at the very beginning of this, is when you're talking to companies, you're trying to extract information, you're trying to learn. You have to be really precise with your questions. You have to think about materiality, right? Like what's material to both, the company or the person you're interviewing or talking to. And so I think it just makes you a better information gatherer. And hopefully, if you do it well in this setting, you can transfer that into the investment setting where you're developing a connection with the person as you're talking to them, right? It might not be top of mind. They might not think that you're developing a relationship with them, but the way you handle the conversation, they may feel it. And if in a game where relationships mean so much, just that little difference, especially if you multiply that over many interactions, I think that can be a differentiator. And so on the teaching side, just for some context, I'm very involved with the value investing program within the UCLA undergrad department, the undergrad economics department. I've been guest lecturing there for years and years. And so teaching, and by the way, I'm not great at it, but I've gotten so much better because I've done it enough. I also guest lectured at Cal State Fullerton. I've had a number of opportunities to continue to guest lecture, which is just wonderful. But teaching forces you to communicate in a way that takes away where you have to eliminate your own knowledge biases and the things that and you have to articulate things in a way that's approachable to other people, some of whom have a lot of understanding of what you're talking about, and some are just being exposed to investing and just are like, have they've taken, a couple courses and they're still trying to understand what it looks like to be an investor. And so I try to, uh, what it does is when you have to teach something, you have to be able to articulate it, but also the process of putting down your thoughts on a slide
Right.
about like, all right, so I want someone to take away this, learn this. How would I describe that? And I think it makes you much more clear in your own thinking, right? Because sometimes you have to write something down to understand what you're really thinking. So I think that the process of developing I mean, I have a 60 slide presentation on corporate governance, capital allocation, and management that I give to the UCLA students every year. And it's a 2.5 hour lecture. It is like no joke. You were up there and you're under, it's just you for that, for a long, for 2.5 hours. Um, I just think that process helps you clarify your thoughts. It helps you, it makes you a better communicator.
Hmm.
And I also get to engage with young people, which is
Right.
wonderful. And just hear the kind of questions they ask, and I'm able to empathize with where, when I was just starting in my investment career, understanding the things that are really important to them, and with the things that they're grasping with, and whether it's a modeling question, whether it's a business analysis question, or like, oh wow, I just dropped 60 slides on them telling them that management's really important. They may never even heard that before, right? And so how do you help people sift through that? That's the fun part. And I learn a lot from my students. I mean, I think, they have such interesting perspectives. They ask questions that I wouldn't have thought to ask. And so I think, just like everything I'm doing, there's a definitive win-win where, I think people think that this is more about me giving. I feel like there's so much I can learn from them, and also the process of communicating with them.
Well, I love the sound of that. I feel like it's the different parts, right? On the podcasting side, you definitely learn to listen. We talked about it. I feel like it's an art, and we all need to practice it to actually hear things. And on the teaching side, I've had interns over the years, and I enjoyed so much the questions that they ask because they have such a beginner's mind, fresh look at things. And it's so fun to see how their minds work and what kind of things they want to ask. And I definitely learn as I go. But the last aspect that you and I spoke about is that at some point of our day, we sit down with a client and we explain what we do. And I think it's very helpful to realize that you want to meet them where they are and explain things in a way that's accessible, digestible to anyone. And it doesn't come naturally. I think it's a practice. And if you're surrounded by fellow investors and everybody starts the conversation kind of in the middle because they know the terms, they know the names, they know the language, and you have to sit down with somebody who is very curious, what is it that you did with the portfolio, but maybe needs a little bit more help. I think teaching can be a wonderful way to see a different perspective and kind of take a pause for a second and explain what you do to somebody who is fascinated with what you're doing, but maybe needs a little bit more guidance. Yeah, so I think it's fascinating that you get to do both podcasting and teaching. I think it's wonderful. Ben, before I let you fly away, I do have to ask you about success. You know that I like to ask my guests about their definition of success. How do you think about it?
Yeah, I mean, we talked about this a little bit. I want to be enjoying what I'm doing. The old Buffett idea of tap dancing to work. For a number of years, in my last few years at Cove Street, I don't think any of us were tap dancing to work. And that was unfortunate because this can be such a wonderful job, right? I still feel like, investing is one of the best jobs in the world, right? And I would do it even if I wasn't, doing it full time, because I love learning about businesses. I like interacting with people. I like listening to people describe their businesses and learning about that. So I want it, wherever it is, whatever I'm doing, whatever, wherever this journey takes us, I want to be having fun first and foremost. Um, I think the other thing that is important to me, and this goes back to the things we've talked about, is, you know, just finding a way to be doing something a little differently. and there can be varying degrees of success, right? And maybe we're so successful we it's no longer different because they're copycats. But it was impressed upon me, when I went on like a 9-month listening tour of the investment industry after I left Cove Street. It was impressed upon me how little differentiation is really available in equity markets, and you could say that in public and private equity markets in a lot of ways. And so I like being a bridge. I like being a hybrid. I like breaking down silos, and that differentiation, I think, is the only way to be successful. And as a new firm that doesn't already have scale and resources and size and tons of people. So I mean, I think I don't the constant one thing that the validation that I get so early on in this process is like, wow, you guys are doing something different. And to me, that's not, sufficient for success, but I think it's in today's world of capital, so with as much capital sloshing around as there is, you know, differentiation is a must. And then lastly, just it's really about being around people and working with people who I enjoy this process with. It sounds like that's that's part of the fun, but also just like success to me is like I'm just talking to interesting people all the time, learning from them, leveraging their knowledge, being totally willing to ask the stupid questions. And believe me, I've been asking people really, really stupid questions about private equity. And look, maybe there's a fair amount of humility in that. I'm learning a new industry after, a long time in the public equity markets. And so, I want to be having fun. I want us to continue to be different. And then I just want to be enjoying the people around me and learning from them in an environment where I'm just constantly learning from like anybody I'm interacting with. That's the success. And look, getting back to like the businesses that I think are the most successful is like, the ones that focus on their customers and employees the most. Like that's kind of it. Like a similar thought. Like if you focus on your customers and employees, everything else works. If you're having fun and you're different and you're enjoying the people around you, I think that the financial side will work itself out. And so that's how I'm operating every day. And, we'll talk again in 5 or 7 years and see where that actually ended up.
Well, I think you're up to something fascinating, interesting. And I'm thinking of the word passion, which just beams through every time we speak and during this conversation. I think passion is not something you can fake. I don't remember who had the saying how, you go to a wine tasting, if you're not into it, you're not into it, right? And I think investing is one of those pursuits that you can fake it for a year or two, but if you're not into it, you won't stay for 2 decades. And you and I have been in this business for about that long. And I was falling asleep last night and I was reading about a company I haven't looked at in a while, and I'm just excited to look at it. It's not that my initial thought is not, oh, I'll make money in it. It's just, I'm curious what's new, what they've changed. And it's just curiosity, and it's endless and it's open-ended, and I'm having fun with it. I'm reminded of something that an instructor told me. I fly small planes, and my instructor told me once when I was flying to a new airport and I was a new pilot, and he told me, just tell the tower that you're a student pilot and they'll help you out. And immediately on the other side, they say, okay, and they give you a lot more background and information about this airport because you're new. And I catch myself, although I have 20 years of experience, that there are moments where I feel like I'm just learning something new. If it's a new industry, I talked to somebody about AI earlier today, I feel like a student pilot again, and just tell me as much as I have to know to get up to speed with what we're talking about. And I think having that kind of humility that I don't know everything yet, and there might never be a time when I know everything. You and I talked about microcap. I learned about microcap more today than probably over the last 5 or 10 years, just talking to you today and the last few times we spoke. I'm always curious to learn what else should I know. And I think you can't fake it. And that's what you really need in investing, that kind of passion that you'll show up and you will want to learn. And on the other side, what you mentioned so many times in this conversation, there are people in terms of your clients, in terms of businesses that you invest in. Remember that and respect that. And I think that will help you. And be kind to them because they'll be kind back to you at some point of your life. So, Ben,
There's
this was
a lot of common sense there, right? Like be
right?
okay being a student pilot through, even when you're Warren Buffett's age, and
Exactly.
think about relationships first, everything you do. If you do those things, right, like I think like a lot of good things are going to happen for you, and on average.
And the money will follow. You'll be fine.
That's
Ben.
what we're hoping for. Tell me. Still got a steep hill to climb, but it's been an enjoyable ride so far.
I can tell. I can tell you're having fun. I love seeing that. Ben, thank you so much for today. I really enjoyed it. It was a delight talking to you and learning more about the work that you do and filling in all the gaps. And I thank you for letting me ask the questions. And
Well,
I
no,
appreciate
thank
you.
you. Thank you for letting me ramble on about microcap. And thank you for your thoughtful questions and your approach. That's much appreciated. And I'm just very, very glad to have you in my life, and the fact that we've been able to share a couple conversations with a lot of share our conversations with a lot of people. It's just it's a blessing.
Well, I learned a lot. I'm sure the audience will enjoy it, and everybody knows where to find you. So everybody listening, just look up Ben and the work that he does. And I'm sure there'll be more coming out from you about the new strategy that you're getting started. So I'm very excited for you guys. All right. Thank you, Ben.
Thank you.